Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. Joining me today is Dan Russo. Dan is a technical analyst and portfolio manager over at Potomac Fund Management. Prior to joining Potomac, Dan was a sell-side analyst covering some of the largest hedge funds in the game. He's also an adjunct professor at Baruch College in New York City, where he teaches a class on technical analysis. So he's a real pro, and I'm excited to hear his take. But before we talk to Dan, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thank you for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. All right, so it was a shortened holiday week, but stocks rebounded. All four major indices closed higher on the week. The Russell 2000 led, rising more than 4%. The Dow lagged, but it still bounced about 2.7%. Now, taking a look at the S&P 500, it snapped a 3-week losing streak this week. For all my Fibonacci fans out there, we bounced right at the 61.8 retracement of the entire summer rally. We ripped right through the 50-day moving average today. So it was a very constructive ending to the week, but we're still below those June highs around 4,200. So we're still in this kind of messy environment, and you really want to see the bulls build on their recent success next week. Taking a look at the sector performance real quick, all 11 sectors closed higher. Consumer discretionary led, while energy was the laggard. Now, joining me to talk about all this and more is Dan Russo of Potomac Fund Management. All right, Dan, welcome to the show, and thanks for coming on today.
Patrick, thanks for having me. Pleasure to be here.
Yeah, it's great seeing you again. And
you too,
I've wanted to have you on the show since I started the show, so I'm glad we can make it happen.
Yeah, it's fun.
But before we get into the market stuff, I want to just talk about your background a little. I met you when you were still working on the sell side over at Needham & Co.
Yeah.
And since then, you've joined Potomac Fund Management. So could you just tell us a little bit more about Potomac Fund Management and your role there? Because I get asked a lot, what is Potomac? Is it an RIA?
Yeah, so we are an RIA, but we're not planners, right? We're not working with the end client. What we do is provide tactical portfolios for financial advisors. So we have 4 funds that we manage with different risk profiles. Those 4 funds get combined in different weights to create strategies, and strategies are then available to financial advisors through different TAMPs and different platforms. We also have a research arm, which I head up. So I wear 2 hats here, one of portfolio manager and one of director of research. The research arm is really just a function of kind of making my notes public, if you will. Things that I'm paying attention to anyway, things that I'm writing down all the time. We decided to make it available to financial advisors to utilize as part of their process. And it also serves as kind of an R&D lab for some of the things that we are doing on the money management side. So director of research, 1 hat, portfolio manager, other hat.
Yeah, I'm a huge fan of your notes. You put one out pretty much every day, and they're free too on the website. And I usually include them in the chart report. But I also like
appreciate that.
Yeah, I like how you have kind of a weekly schedule. You have the sentiment or the relative strength note. You have the breadth note. Once a week. And that's a good way to kind of benchmark things. And I'm sure as an analyst, it's a good way to kind of see how things are progressing, right?
Yeah, I mean, look, for me, it's kind of like a part of process. It's something I've been doing for years anyway, and just kind of making that available to our advisor clients and, like, as you said, for free on the website. But again, I think at the same time, having a publishing schedule and looking at things, at least on a weekly basis, allows you, as close as possible, to see changes as they're taking place, or as soon as they're taking place as you possibly can. It also allows you to be a lot less reactionary, right? If you have a process and you're looking at the same things over and over again, like I know I'm going to speak about breadth once a week. I know I'm going to speak about, sentiment once a week and sector rotation, et cetera. instead of, everybody's talking about this one shiny object over here. So now I'm being reactionary and saying, well, I should talk about that too. No, like that, to me, when you're the 15th person talking about something, you're adding zero value. I would rather talk about what I talk about on a weekly basis and try to catch the changes as they're happening. And to me, that adds more value than, again, it's like, you just kind of look at widely covered stocks, right? How many analysts cover Apple? The 45th analyst covering Apple, probably not adding a ton of value.
Right, right. So you also teach a course on technical
I do.
analysis over at Baruch College in Manhattan, and that's got to be a lot of fun. I mean, there are really only a handful of colleges and universities out there that even offer a course on technical analysis, which is mind-boggling
Yeah.
to me because they're still trying to jam efficient market hypothesis down students'
Yeah,
throats.
look, I think that, everybody wants to be an investment banker, right? So a lot of those, the curriculum is heavy on, finance classes and not as much technical analysis. So I kind of fell into this role really. Bruce Kamich was the teacher or the professor in the class, and he was thinking about retiring, and I had guest lectured there during his class a couple of times. He invited me to come in and speak. And then as he was kind of thinking about retiring, he asked me if I wanted to take over the class. And I said, wow, that might be interesting, pretty fun. And it was, and still is, ton of work in the beginning. I can honestly say I underestimated how much work it would be, because I kind of figured, I know this stuff, right? I'm a professional. I'm technically an expert at it. I'll just go in and talk about technical analysis, and it's not really what it is. You kind of have to think it through and come up with a syllabus and a curriculum and, things like that, which I've done now at this point. So yeah, it is a lot of fun. The students, they seem to enjoy it. I know the class is always oversubscribed. There's probably close to 100 students in it this semester. And I know that there was a waiting list because I get these emails of, people who are on the waiting list asking if I can do anything to get them into the class. So it is fun. It gives me it's kind of interesting in that having to go and teach everything, or the entry level curriculum for technical analysis kind of forces you to go back and revisit things that you haven't revisited in a long time, right? You get set in your ways. I think you find the indicators that work for you. You find the types of charts that work for you, moving averages that work for you. And then you have to go, teach all of the indicators. And all of a sudden you're like, wow, that's kind of interesting. Why aren't I using that? Let me revisit that. So I actually do get a benefit from it in terms of, just kind of, I enjoy seeing the students get it. And, I enjoy seeing them kind of want to put a process in place, as opposed to, just looking for stock tips and, turning on CNBC and saying, hey, what's Kramer recommending? Let me buy that. Like, seeing the students want to put in the work is really rewarding.
Yeah, I mean, they say the highest form of understanding a subject is being able to teach it. So I'm sure you learn a lot too. But
you do, it's amazing. You learn a lot. You learn a lot just going back and, creating the lectures. And I've done it a few times where I've been like, why? This is kind of a cool indicator. Why aren't I using this? And then of course, like now I'm in a position where I say, okay, I'll do that. And I bring it, and everything we do at Potomac on the money management side gets tested. It's quantitative and systematic. So we don't do anything without testing it. We're not, it's like, hey, we have a trend line breakout, let's buy something. No, it's not how it works for us at all. So anything that looks interesting, we bring it in, we code it up, and we test it, and we see if it adds value, and run from there. So it all kind of comes full circle, right? Money management, research, teaching. Plus I just kind of like talking about this stuff.
Well, you're in the right place for it. So let's move right into the market stuff. We'll start with the S&P 500, and we're recording this on Thursday of a shortened week. And at this point, the S&P 500 is actually up about 2% on the week. And so we're on track to snap that 3-week losing streak. But at the same time, things are still really messy, right? We're below a 50-day moving average and the 200-day moving average and those June highs. So It's kind of just a mess right now. And the question I've been asking all my guests lately is this a bear market rally, or are we in a new bull market? And of course, nobody knows for sure, but I want to hear your perspective on that.
Yeah, I think it's one of those questions that you don't know the answer to until after the fact. And I realize I'm kind of punting there, but it is what it is. To me, I guess if you had to pin me down, the way I describe myself when people ask nowadays is I am neutral with a bearish bias. I think, you just looking at things objectively from a trend perspective, you're below a 50-day moving average. As you said, you're below the 200-day moving average. You're below those June highs, right? That's kind of bearish in my view. However, there have been some developments of late that lend themselves to making a bullish argument. If you wanted to make the argument that we are in the early stages of a basing process, you want to call it a new bull market. Okay, cool. However you want to label it. So I think that there's enough there to keep you honest. I think that there's enough there on both sides that it's hard to have high conviction in either call. I think that if you're below the 50, if you're below the 200-day, if you're below those June highs, you have to be thinking about the June lows. They're certainly in play. And the way I kind of think about things is incrementally, right? You kind of look at, we've had some breadth thrusts of late, and I know we're going to talk about breadth. We've had some breadth thrusts of late that's interesting. So those kind of things, can help you get incrementally bullish. But when there's no follow through, which we haven't seen, right? When you don't stay above the 50-day, when you don't get above the 200-day, you have to say to yourself, okay, all right, I was incrementally bullish and now I'm not. And that's kind of how I view the world. It's not so much, are you bullish? Are you bearish? It's, kind of like assessing the odds, right? And so the breadth thrust kind of helped increase the odds that the market was going to go higher, but obviously didn't guarantee it. And nothing's ever guaranteed. But when there was no follow through, those odds diminished and you have to kind of recalibrate and adjust again. So you want to pin me down. I'm neutral with a downside bias.
Yeah, I think a lot of it does just come down to semantics. Walter Deemer shared a really interesting analog. We've all seen the '08 analog too much. But he shared, I think it was 1962, and it was a very similar year in the sense that it was a terrible first half. You got a bottom in June, and then you got a double-digit rally over the summer. And then from there, we went down to retest those lows, but we successfully held them. But you pretty much erased that entire summer rally. So there's a scenario where like both are wrong. You can't call it a new bull market really, because it retraced over half of its gains. But then you can't call it a bear market rally either, because it never really made a new low, right?
Yeah, I think that's fair. I call it a base, right? I think it is semantics. I think because all arguments, or not all, but I'll say 95 to 99% of arguments in the market come down to time frame, right? When 100%. Somebody's bullish and somebody's bearish and they're arguing with each other and, going back and forth, whether it's in, face to face or on social media, usually it's a difference of time frame, right? And if, to look at this chart of the S&P 500, it's pretty, you can say, that it's bearish, right? But if you zoom out and look at a 25-year chart, right? Let's exaggerate. Look at a 25-year chart, right? The market is in a secular bull market, right? So, somebody who's taking the long-term view will be bullish, and somebody who's maybe trading and is a little bit more, in and out of the market and they lean bearish, and both are right. When I teach the class, I say, look, something that you need to understand is there are different trends of different timeframes playing out all at the same time. I said you can have a short-term downtrend within an intermediate term consolidation within a secular uptrend, and all three of those things are correct at the same time. Right. So I think that, kind of labeling it and going back and forth is semantics. And unless two people have the same time frame, what are you arguing about? It's not even apples to apples at that point.
Right. I see a lot of those arguments on Twitter and stuff.
Yeah, they're dumb. It's not worth getting into.
Right. You just want to tell them, hey, you guys can both be right and wrong at the same time. And it very well might play out that
100%. So I think it's more of a, you have to take a weight of the evidence approach. And I think if you look at all the data points now, I think you hit it right. Sloppy. It's sloppy, right? Could I, do I lean bearish? Sure. But, is that a super strong conviction view? No, there's enough out. The advanced decline line for the S&P 500 made a new high 3 weeks ago. New all-time high. The S&P, you have the NYSE up there. But if you look at the advanced decline line for the S&P 500, it made a new high, I think it was August 16th.
Yeah, just briefly, right? It didn't hold very long.
Didn't hold, but still, like, where'd that come from? That's
Right,
if you're going to sit there and be uber bearish, you probably don't want to ignore that data point. Right?
right.
You did have breadth thrusts. You did have these breadth reversals, right? If you look at the speed with which the percentage of stocks, trading above their 50-day moving average went from less than 10 to greater than 70, 75. That is a breadth reversal. There's some validity to it, right? A lot of people started posting about it. I mean, first thing I did was code it and test it. And it's a solid signal. It's, nothing is great on its own, right? Let's be clear there. I think that a lot of where people attack technical analysis is where they attack it indicator by indicator. And they say, well, this is not that good. That's not that good. That's not the point. It's when you put these things together, right? But there was certainly a thrust. I mean, just look at this chart here. You can see that, back in July, less than 10% of stocks in the NYSE were above their 50-day moving average. And then by mid-August, that number was over 80. That's a huge move. So
Where did it start from?
So
where did it kind of wash out at?
I mean, sub 10, I think it was like 5%.
Wow.
And so to be an uber bear is to ignore these data points that are out there. So I think it's hard to have a ton of conviction. Now, I do lean bearish, right? Because the trend is down. And I think one of the charts you have is the same thing, except percentage of stocks above their 200-day moving average. That just cannot gain any ground.
Right.
Has not been able to gain any ground. So what you've seen is, and we look at the percentage of stocks above their 20-day also. So what you've seen is these spikes in the short and intermediate term breadth metrics that do not bleed over into the long-term metrics, right? And until, those spikes are sustained to the point where they, bleed into the longer term metrics, such as this one, right? The percentage of stocks above their 200-day moving average, it's hard to get really bullish also. And then, here's the index trading below a declining 200-day moving average. And it's just kind of hard to get all bulled up, right? Advanced decline line back below its 50-day moving average. The index coming into today below its 50-day moving average. So there's enough data points there. It's kind of a tough market because there's enough data points that you can make a case on both sides. So I think it's, sometimes you just have to sit back and wait for trends to develop.
Yeah, I mean, it goes back to what you were saying about trends occurring at the same time in multiple different time frames. And you wrote a great breadth analysis piece today. And it seemed like the key takeaway was kind of what you're saying, those mixed signals where you have
not enough,
the breadth
right?
thrust.
Not enough to get excited.
Right. We got those breadth thrusts towards the end of summer, but they never really materialized anything. You didn't get follow through yet, at least. So that's positive. But at the same time, you have some of those other metrics like, the percent of stocks above the 200-day that does look pretty weak.
Yeah, and here's what's even more fascinating is as quickly as you've had those thrusts, right? I think a week ago I wrote a note talking about short-term breadth getting washed out. So if you looked at the percentage of stocks above their 20-day moving average for the S&P 500, S&P 400, S&P 600, so basically the individual groups that make up the S&P 1500, all three of them were less than 10%.
Yeah, I saw that. So Andrew Thrasher shared a chart showing it got down to like 4%.
Right, but Wednesday, all three of those indexes were sub 10%. Right, generally speaking, that's kind of a washed out level. So you said the market's up about 2% this week. We weren't surprised to see that. We actually wrote washed out levels could be wouldn't be surprised to see a bounce here. We put some numbers behind it in a note that we sent out to advisors, and that's kind of what you're seeing play through. But until that starts to be sustainable at these longer time frames, they're kind of just trading calls.
I want to move on to sectors next. I think one of your strengths is your sector analysis. You write a weekly note on it, and you cover all 11 S&P 500 sectors on both an absolute and relative basis. So it's a good place to get an idea for where the relative strength is at in terms of the sectors. So the sector I want to talk about today is utilities.
Literally the most boring sector on the planet, but trading near all-time highs. So
totally
not boring in our world.
And I'm pretty sure it was the first sector to reach all-time highs on this cycle.
It
And
is.
that breakout hasn't really materialized into much yet, but as you pointed out, we're less than 1% away from all-time highs. So do you like utilities here? I mean, they've been the strongest performing sector over the past 6 months. And does that leadership, seeing a defensive sector like utilities lead, does that concern you at all?
I mean, listen, obviously it's part of the process that leads me to kind of be neutral with a downside bias, right? You clearly don't want to see utilities outperforming if you're a Super Bowl, right? It doesn't work. I mean, the group has been in a choppy uptrend on an absolute basis since the COVID low, right? Everything has been an uptrend, but this has just been like a sawtooth, choppy uptrend. But of late, to your point, over the past six to 9 months or so, it's been an outperformer. And that's where we focus a lot of our attention is on the relative side. I think that, especially for advisors who are, looking to add value for their clients, sector rotation is a way to do that, by just kind of focusing on what's outperforming and tilting slightly away from what's underperforming. And we're not, I'm not saying you should look drastically different than the benchmark, right? But, little tweaks here and there at the sector level can add a ton of value just by focusing on relative strength. Now, Drew Wells, who is our analyst on the research side, just wrote a piece about this, looking at relative strength and how it can be utilized, whether it's at the sector level or even at the asset class level, right? There's the market's big and it's more than just stocks and bonds, right? There are these things called commodities out there. There are, if you want to call crypto an asset class, okay. The simple fact of the matter is you can look at what's leading, look at what's lagging, and make, little adjustments to your weights that can lead to outperformance over time. So if utilities are outperforming, who am I to argue with that? If you want to kind of dive into the narrative and the message of the market, I would say that that's a data point that supports having a bearish bias for the most part. Now, are there times where utilities outperform in a bull market? Sure. But, more often than not, utilities are a flight to safety trade, as are staples, and they've been outperforming. So, if I'm making a checklist and going through the weight of the evidence approach to come up with my view, that one goes into the bearish bucket.
Yeah. So you shared this awesome chart earlier today. And I want you to just kind of tell us a little bit more about what's going on here.
All right. This kind of gets to what I was saying about making, little tweaks at the sector level to add value. And basically the top chart here is utilities on an absolute basis. The bottom chart is communication services, again, on an absolute basis. And, comm services is obviously a group we all know. And, Facebook or Meta is in there, and, Google and Netflix and, the who's who of what we think of as tech, but is not really tech from a sector classification standpoint. And I guess this was part of a video that we did. And my rant was that if you just buy the index, you are making a conscious decision to overweight that bottom chart relative to the top one by more than 2 to 1, right? Those numbers there, 3.16 and 8.41, are, according to Y charts, the weights of those two sectors in the S&P 500. So buying something like SPY, right? You have decided to take an 8.4% position in comm services, which is clearly in a downtrend, and only a 3.16% position in utilities, which is clearly in an uptrend, right? So you don't have to be heroic, right? If you took that 3.16, and I'm not saying you should do this, I'm not giving advice here, and I'm certainly not speaking about anything that we're doing, but just hypothetically, if you took that 3.16 to say 5%, a 5% position, you've now overweighted it relative to SPY, and you are now have a slightly overweight position to a sector that is outperforming. And, you need 1.84% to do it. So if you took that 1.84% from the comm services bucket, you've now slightly underweighted the thing that's in a downtrend and could conceivably add value. So I think that that's interesting. And, for us, in fairness, and we've been writing about it, and we've been writing about what a train wreck comm services have been for months, and how utilities have been an outperformer. So it's just, to me, without even being heroic, just a focus on, one note that we write a week, comes out on Tuesdays. Just that focus can help add a lot of value.
Yeah, and I really like your focus on relative strength. I think, and your point about making
We live in a
little
relative
tweaks like
world,
that.
right? We live in a relative world. And I spent 10 years covering large institutional money managers, right? Most money managers are benchmarked to something, right? Whether it's the S&P 500, if you're a small cap manager, you might be benched to the Russell 2000. So relative performance is what large money managers live and die by, right? And when I say large money managers, I'm still talking, like, the world loves hedge funds, right? Hedge funds are sexy, but the majority of money out there is run in kind of plain vanilla long only strategies.
Passive.
And those plain vanilla, not passive, long only, like a mutual fund, a long only mutual fund. And that long only mutual fund manager is benchmarked to something. So that manager is paying a lot of attention to relative strength, right? If a large cap fund manager is benchmarked to the S&P 500, then his or her job is to beat the S&P 500 year in and year out, hopefully, or at least over time, right? So in a year like this, right, where the S&P is down mid-teens, if you're a large cap manager and you're down mid-single digits, I'd argue you did a great job, even though you're losing money. I would argue that you did a great job. If you're beating your bench by 10%, you're probably doing a really good job, which is why relative performance is so important.
Yeah, I mean, speaking of relative strength, let's move on to the big topic of the week, which was, of course, commodities. Still the only place to hide out in terms of asset classes. They're up like 18% year to date still, but they've come under a lot of pressure recently. They broke below the 200-day moving average for the first time in nearly 2 years this week. So what do you think here? Was that it for the bull market in commodities?
Just if you kind of look at commodity cycles, they tend to last a long time and they don't go in a straight line. Obviously, nothing goes up in a straight line and nothing goes down in a straight line. But just kind of look at previous commodity cycles. The commodity cycle that everybody associates with the inflation of the 70s actually started in the late 60s, 1968, 1969, commodities bottomed and then rallied to 1980, right? So, a 12 year cycle in commodities. And then commodities bottomed in 1999, right ahead of the bursting of the dot-com bubble. And then depending on which commodity you look at, there was a top in the commodity index in about 2008, and gold topped in 2011, right? So my hunch, my take is that we're still early days of a larger commodity cycle, right? So now if we think about what we were talked about earlier, that there could be multiple trends playing out at the same time, it appears that we are now in a short-term downtrend within a longer-term secular uptrend for commodities. So, incrementally, we've been table pounding bulls on commodities for a while. I actually first started talking bullishly about commodities in July or August of 2020, prior to even coming to Potomac. And so, okay, incrementally, like I talk about, my views change incrementally. So I guess at this point, below the 200-day moving average, right? Am I going to be as bullish as I was above the 200-day moving average? Absolutely not. But secular trend, I think that this is probably a pause within a secular uptrend. I think energy is a big part of it. It's a huge weight within the index. And energy is, well, here's crude. Here's crude rolling over and breaking some key support levels. So you can't argue with that. Like, I'm not going to sit here and pound the table for a short-term trade in commodities in the face of this evidence. But longer term, to me, this appears to be a kind of a stalling or a pullback within a secular uptrend. Yeah,
well, Dan, if people are interested, where can they find more of your work?
On our website. Just head over to Potomac's website. We are very transparent in a lot of what we do. In addition, we do. I mean, I write every day, and that's available on the website once every other week. Drew and I have a show a podcast show called Who Charted, where we basically look at 6 charts in 6 minutes. And as you're basically going to be able to see here, I could talk about this stuff forever. And I very, 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 very rarely stay within my 1 minute per chart guideline. And that's fine. It's now become a running joke. But yeah, a ton of content on our website at Potomac.
Yeah, you and Drew and Manish, I might have just butchered his name, but you guys are
It's good. Manish,
doing some great work over there.
thank you. I appreciate it.
But anyway, we got to wrap it up now. But thank you so much for coming on the show today.
It was a pleasure, man. Thank you. It was fun. I'll talk to you soon.
Yeah, absolutely. Bye.
Bye-bye.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe. We're traveling next week. We have a couple conferences to go to, so I can't promise you an episode next week, but we'll be back before you know it, so stay tuned.